Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. John Polomny of Actionable Intelligence Alert joins us to talk about the commodity and energy markets. John is a seasoned investor who emphasizes buying undervaluation and selling overvaluation. In other words, buying cheap stocks and selling expensive ones, which is the goal of everyone watching this show. Today, we're going to ask your questions and pick his brain on exactly that. John, thank you for coming back on the show.
Happy to be with you, Steve.
Yes, sir. The pleasure's all on this side of the table. Let's start out like we always do. And what is your macro view of the world economy and financial markets?
Well, my overall view and the thesis that I'm operating from is that we are in a period now that's what I would say is a historical period where we have the current world hegemon that's been in place for probably, let's call it the post-World War II neoliberal world order that's been dominated by the Atlanticist, Anglo-American Atlanticist hegemon, is now giving way as the emerging Asia, emerging global East and South is now flexing its muscles economically, which leads to eventual, political, wanting more political power, wanting more influence around the world. And I think that this is causing a tremendous amount of economic, political, and social change in the status quo, and that's being reflected, I think, over time into various markets. I stole something from Jim Rogers that kind of makes sense here. This is a longer term phenomenon that's developing, and he said something in one of his books. I think it was something like the place to be in 1800 was London, the place to be in 1900 was New York, and the place to be in 2000 going forward is Asia, whether you want to say Singapore or Beijing, whatever, So that's kind of what we're seeing, and we're seeing as these countries in the global South and East, like I said, get more economically, they get larger, and they represent a larger and larger portion of the world economy. They have certain political aspirations or ways that they want things to go, and that's coming into conflict, I think, with the order that's been in place for, like I said, probably since the end of World War II. And so I think that's causing a lot of economic, political. I basically say, I don't use this as hyperbole. I say that we're basically in a cold World War III that could very easily go hot. A lot of people don't agree with that, but I think it's pretty obvious, as you can see, various proxy wars. There's going to be more trade wars, things like this, economic war, the U.S. using the dollar and various other instruments. So I think a lot of these things, I get a lot of pushback. I wish you would just pick stocks and not get in the political. You have to be involved in the political. The political now is so ingrained. It's not like we live in a Milton Friedman libertarian, nirvana where the state just, has a night watchman status. They involve themselves in everything, whether we like it or not. So I think it's imperative to graft that onto your thinking and as you develop a thesis. But I say as that situation grows, for example, a perfect example is the decision that the current hegemon has made, in Western Europe, for example. Western Europe is a complete basket case. Okay, you can go. I'm not going to go through all the countries unless you'd like me to, but we have basically, if people aren't seeing, all these different governments have collapsed, and yet they still hold on to power. And so there's no. You saw what happened in the United States with President Trump being reelected. Trudeau's on his way out. The stoplight coalition in Germany has collapsed. Macron somehow clings to power. Stammer just got in the UK. He's already at record lows in approval. It's just the reshuffling of the deck chairs. For example, in Germany, you have a situation where they're going to have snap elections in February. And one of the main parties that's growing because of the because of the economy there, AfD, is being excluded. So you're just going to reshuffle the stoplight coalition. Instead of having SPD in charge, making a coalition, you'll have CDU or CSU. So nothing really changes. And so, it's almost as if a place like Europe is almost uninvestable at this point. So that you're living in a historical moment, I think, and it's going to create a lot of opportunities, a lot of risk, a lot of volatility. But again, um, you know, we're seeing this emerging global South and East. I'm very bullish on Latin America. I'm very bullish on what's happening in Africa. I mean, India has traditionally been a very poor country, but, compounding works. And so there's various little situations around the world that I like. And I'm getting more and more worried about the United States going forward, because as I say that the world is in a cold World War III, the United States is in a cold Civil War. We have basically 50% of the population on both sides of the aisle that really, it's an incompatible union at this point, in my view. And these are, again, a lot of people consider this hyperbole. This is you're off your rocker, but I'm moving the Overton window a little bit. I think I can make the case for these things, and these things are going to have tremendous, as I said, economic, political, and social upheaval that will affect markets. So that's a little bit wordy, but that's kind of how I'm looking at things. But that, again, that doesn't mean there's not opportunity everywhere.
Okay. So basically, what you're saying is you're seeing a general transfer of power from the west to the east, which is causing you to be bullish on Latin America, India, Asia, and parts of Africa. Um, Probably one of the best examples of this would be Germany, where their politicians are just completely shooting themselves in the foot, and it's almost like they're doing it on purpose.
Well, Steve, you have a situation in the West, in large part, where you have a governing class, if you want to call them that. I refuse to call them elite. These are all carpetbaggers and bums and hanger-ons and parasites. And people don't like that either, because, like I said, 50% of the population are statists, at least. So, but these people have no caring for the populations that they're governing. They are wedded to this globalist project, or this project of the EU project, because they benefit from it. I mean, I hate to use Mungerisms, but he's my favorite guy. Show me the incentive and I'll tell you the outcome. Frederick Mertz and these people, even, Alice Weidel, who's in charge of the AFD, she's a globalist, Goldman Sachs alum. I mean, these people all come from the same mold, okay? And so inevitably, you're not going to get to these positions of power in the West and making policy. They come out of the same thing, the same think tanks, the same universities, the same bubble. And so, as I've said before, you're going to need these things go in trends, they go in waves. And I've made the prediction, which I'm sure we'll get to uranium. Eventually, Germany will turn their reactors back on. Okay, for example, eventually they're going to have to. Can you imagine the economic power of a Germany with world-class engineering and manufacturing prowess? That's what they've been known for, especially their medium-sized family-run businesses. I forget the German term for it, that have been around for sometimes 100 years or longer, coupled with basically infinite Russian resources and a complete Asian market that they can access via rail and sea, that landmass. That's what this is really all about. The globalists, the people in the United States, the Anglo-American hegemon doesn't want that. We're talking about the Mackinder doctrine again, the big island. If that was to happen, and you have all these Asian markets and African markets and all these things that are expanding, what's the U.S. do sitting over here by itself? This is what this is all about. And so you blow up the pipeline in Germany, which is your cheap energy, and energy goes into everything, as we all know and realize. You raise your cost basis for German manufacturing, and now you're deindustrializing the state. You get to a point where you won't turn it around. And if you don't believe me, drive through rural, small towns in Ohio, Indiana, Illinois, Michigan, these places where there was massive amounts of manufacturing in the 50s, 60s, and 70s, and we threw it all away. Our politicians threw away. The same thing can happen there, and it's almost impossible then to turn it around. And so can you imagine? So, it goes back to, it's not me saying this like I'm fostering this idea. The first guy that started NATO said this. I forget his name, The purpose of NATO is to keep the United States in Europe, to keep Russia out of Europe, and to keep Germany down. Okay, this has been like, this is the whole basis of another reason why World War II, World War I started. Okay, when the Great Britain didn't want Germany was expanding as an imperial power in World War I. I mean, there's other reasons, but this all goes back to this whole great island. It always is about money and power, and people forget these things. And but can you imagine? And so goes Germany, so goes the EU. And so you're already seeing fracturing there. I mean, the EU will not exist as a political entity at some point. I don't know if it takes 10 or 20 years, but, it's running on inertia now, and that's it. I mean, who would want to join that block now? And, I don't even want to get into some of the other more inflammatory things around immigration and Islamization that's going on there. But, that's a whole block of 700 million people that's basically economically stagnant. So, yes, there's opportunities everywhere. There's still opportunities, different things in Europe. It's not like totally devoid of any opportunity, but that's not where you want to put the bulk of your money. And so that's what I'm talking about when you have to kind of tie all these things together. What are the long-term trends? You get that right. And then, you can then distill down into individual companies or methods or vehicles to take advantage of a longer-term trend. That's kind of what I'm trying to do here. So anyway, I don't know. I kind of got off track a little bit, but
No, that's all right. I took you there. Thank you. Okay, you follow central banks quite a bit, and Mr. Ottiger has a question. He says, John, do you see any plausible scenario where long-term treasuries actually catch a substantial bid, even if it was short-lived? So basically, I think he's trying to bet the TLT or, kind of the 20 to 30 year bonds here and catch a trade. Do you see any opportunity there?
So let's look at this because it kind of flesh out my view, and then I'll give you the answer that I have for that question. So without getting too deep into the weeds, we had a bond bull market that lasted 40 years from basically the early 1980s until recently. Okay. The best investment you could have bought when interest rates were at 20% and Volcker started cutting rates back in 1980 or whenever it was, is buy like zero coupon bonds, treasuries. Okay. You would have probably had you would have had a compounded rate of return of like 15 or 16% a year. Okay. The bond bull market's over with because all of the things that facilitated that disinflation and that ability to lower rates, that's changed now. What caused the ability of inflation and rates to come down over 40 years? Well, we had China enter the manufacturing. Well, for example, the Soviet Union collapsed. Okay, so before they collapsed, what were they doing? They were flooding the world with commodities. So you had commodity prices come down. You had China then open up, and they didn't have resources, but the resource they did have was cheap labor. So they arbitraged their cheap labor. That's kind of gone away now. And, then you had this deregulation and disinflationary bias that happened because of deregulation, some other things that happened in the U.S., and then the financialization of the U.S. economy. We went away from things and real assets to financializing everything. And we've seen the results of that through the various, financial crises. So now we're getting to a situation where we've reversed that now. We have an aging population. We don't really have necessarily a line of sight to commodity deflation because we've had underinvestment for years and years and years. We can get into that and specific commodities simply getting harder to find, cheap to produce oil fields and copper. And I mean, everybody knows this. The low-hanging fruit's been picked. So that's gone away. China is their population shrinking and their labor costs are going up. So that bias to disinflation. So you're in a longer-term environment now going forward where you have, especially in the Western, let's just not even talk about Europe. It's kind of in Japan's the same way. In the developed world, let's focus on the U.S. A U.S. government that is close to $36 trillion in debt at the federal level, with, depending on who you want to talk to, $100 to $150 trillion in unfunded Social Security, Medicare, veterans pensions liabilities that they cannot be paid. If this was an insurance company or a fiduciary that had an annuity, they would be brought up on charges. It's fraud, what's being perpetrated. And so how do you have low interest rates in that environment where you're running supposedly a plus 3% economy right now with 7% budget deficits, which are akin to the deficit levels you would run during a world war?
Yeah.
So yeah, I got a feeling a lot of things are going to change. And one of them is you're going to have a bias to the upside. I'm getting to the punchline now. The bias to the over the next decade or more is going to be to higher rates, not lower rates. Okay. So when you're talking about long-term bonds, I don't want anything to do with them. You can use them as trading sardines. Nothing goes straight up or straight down. There could be periods when, but that doesn't even work. I sold out a trade that I had with TLT because I thought, well, they'll cut rates and the same playbook will work. Bonds will come in, but they didn't. They actually yield on 10s and 20s went up, right? We know that. And, as rates go up, the price of the bond goes down. And so I think if you are savvy enough to trade this, but, why give yourself brain damage and try to be a trader in bonds? These things, they used to call them in the 70s, long-term bonds before the disinflationary Volcker and all that. They called them certificates of confiscation because if you're running an inflation rate of, 3, 4, whatever percent, and a bond is yielding, less than that, then your real yield is negative. Or if you're running 3 or 4% inflation and you have you can buy a long bond and hold it, but inflation will eat away at your yield. So I think I can buy dividend stocks that pay double digits and are pretty stable companies, and they're growing their dividend. And I have more confidence in the ability of the managements that are running these companies than I do these clowns that are running these Western governments that are all bankrupt and are all inevitably going to end up printing a lot of money and to cover this up, because we know the historical narrative is very, very clear. Nobody's going to pay this debt back. Okay, that's over with. That was something you could have done 30 years ago when Clinton and Newt Gingrich made their deal, and we did have a couple budget surpluses. That's impossible now. You have 10,000 people a day going on Medicare and Social Security for the next 15 years. I'll be one of them in 5 years. And these people all want to be paid, and they all vote. And so I remind people of what, Congressman Ron Paul, who a lot of people thought was eccentric and kind of a weirdo. He used to have these sparring matches with the various central bankers, starting with Greenspan. You can find it on YouTube because he asked this question because he was able to do math. And a lot of people don't do math. And he knew that these unfunded liabilities wouldn't be able to be paid. And he asked Chairman Greenspan, we're going all the way back to the Greenspan days. Now, this is like probably mid-90s. And he asked Chairman Greenspan, who was a hard money guy when he was younger. He believed in a gold standard. He was a follower of Ayn Rand. He was in her inner circle. So he knows these things. And so Congressman Paul asked Mr. Greenspan about this, and he said, well, the United States has a printing press. It has the reserve currency, so we can print the money. However, I don't guarantee the benefits will be paid, is what he said, but I don't guarantee the value of the dollars that we. So it's inevitable. Whether you want to look at any historical narrative, the politicians, the leaders will always resolve. They won't do the hard thing. They'll always do the easy thing, and the easy thing is to debase currency. Now, there'll be other little fun things involved too, like Russell Napier talks about financial repression, where they do stuff like, okay, well, we'll just hold the bond rate at 3% and let inflation run at 3.5%, 4%. And now you have basically wealth being stolen from the bondholder that's financial repression, which they did after World War II to get the debt to GDP down. Lynn Alden's talked about this. You can go look at the Fed minutes from back then. You can read about this. That's what they did then. You're going to even have more fun stuff like capital controls. People don't understand. We'll say, well, who will buy the bonds? Well, all you people that have 401ks, who administrates the laws that govern 401ks, IRAs, insurance policies? The federal government. It's very easy to come up with some 1984, we're going to pass the American Reinvestment Bond Act. Oh, guess what? All assets in 401ks going forward or even retroactively have to be invested 30% in treasuries,
Yep.
whether you like it or not.
Yep. Yep.
Oh, that won't happen. It's happened in over 30 countries around the world. It will happen. It's going to happen. Now, these things are not going to happen next week, Steve, but this is your future if you're in the West. These people don't look at you as a citizen or as they're a gentleman farmer and they would go serve in Congress for 2 years and they would come back. No, no, no. This is a whole different class of people that is all about themselves and has an agenda that doesn't include doing what's the right thing. And our political system, I hate to tell people this, that they think is so wonderful, is not geared to fix these problems. You're going to deal with a $35 trillion deficit and in now what you have entrenched deficits on a 2-year election cycle in Congress. It's not going to happen because people figure, hey, it's not going to happen in the next 2 years and it'll be somebody else's problem and I'll be long gone and I don't care. That's the mentality. So these things are the things that need, I say this all the time, the things that need to happen to fix this are not politically possible. And the things that are politically possible will not be sufficient. And so your future is currency debasement, government, capital control, all kinds of fun stuff. People, I tell people this all the time. I wrote a big article about this and put it on my Substack. It was on my website. I refresh it so often. And every holiday season, I encourage people, and I'll make a plug in my videos. I just talk about Social Security. Go to your Thanksgiving Day dinner or Christmas dinner with your grandparents or older people in your family and ask them if they know what the Supreme Court ruling, Nestor versus Fleming, was. And they'll have, of course, have no idea. It used to be on the Social Security website. They took it off, by the way. But basically, you know, people's view of Social Security and Medicare and these things is, well, I paid into it. Like they have an account there, like they have at Fidelity for their IRA. No, 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 no. Without going too far into the weeds, Nestor versus Fleming was a court decision that the Supreme Court made in the 50s, where they said that Social Security is not, you have no ownership of anything in that. It is a program that was created by Congress and can be modified and changed at any time. But it's basically a welfare program, and it will be changed, and it has been changed in the past. They've raised the retirement. They're going to continue doing it. Means testing, raise the retirement age, all these things. Instead of just cutting it off right now and scrapping it and then coming up with a different solution, like maybe have an investment program and it just goes into S&P 500 funds or like a world index, okay, or something like that. And like they have in Chile, for example, and you own the account, and when you die, it doesn't disappear, it goes to your heirs. See, then wealth is created over time. We don't do that here. We have this other Ponzi. But if you tell old people that, they freak out because they haven't planned for their future. See, this is the problem, moral hazard you have in a society. When you create all these programs and people become dependent on them, they give up responsibility for themselves, and then they don't want to hear. So this is the future. And so it's not bringing this full circle without getting off the soapbox. This is not an environment where you're going to have low bond yields and low inflation. That's my point. So anyway.
Okay. All right. So I found the same thing that you did. I had a bit of a trade put on with some long bonds and just realized, like, okay, maybe the bond vigilantes did actually show up, and I'm not a bond trader and I'm not going to pretend to be one. So I took that bet off after a few percent loss, and I will check that up to experience. And on top of that, you're basically betting on a kind of a losing horse in the long run. They're going to have to increase rates over time, and trying to catch some little tiny arbitrage like this is probably not for most people watching this show. Okay, let's move on to one of your specialties, oil and gas. And I'm going to kind of summarize Matthias's question here. What are your thoughts on oil and gas for 2025?
So I have a couple thoughts, and I think they're a little bit, first of all, natural gas, it's too hard. It gives me too much brain damage, so don't ask me too much about it. I do have some, I have some other views on it as far as it being a bridge to nuclear for this AI thing and things like that. Basically, it's underperformed basically the last 2 years. Okay. But that doesn't mean there hasn't been opportunity. I mean, what I find interesting is that we've had a shift away from, it probably happened a couple of years ago. This kind of ties into recent pronouncements by the incoming administration talking about drill, baby, drill. That's not going to happen. And so I think an oil price of $70 to $85 a barrel Brent works very well for the kind of companies I'm interested in. I have I have several companies in my portfolio, that cash flow very nicely at that price. And so if we're in a range so the problem is everybody wants oil to go to 150 or 300, and then they want their penny dreadful that trades on the Vancouver Exchange to go from 10 cents to $10, and you know the story. But I think that a couple things with oil. Oil demand continues to increase, whether people like it or not, because of the ubiquitousness, the easy to transport, the ease of use. It's going to continue to go up over time. We're not anywhere near peak demand. The IEA has been wrong on that. We've had tremendous underinvestment in the sector because why? The growth that we've seen in the U.S. shale phenomenon over the last 15 years. But that's changing in my view. I'm like to read the work of Goring and Rosenzweig. They do a lot of good work. They come out, as you probably well know, every quarter they have a resource commentary. It's about 30 or 40 pages. And one of the things Adam Rosenzweig, who's one of the principals there, has been writing about is the inevitability of peaking of shale in the U.S. And he's not the only one. There's a lot of discussion and arguments about this. And I would suggest to you that, basically the emergence of shale 10 or 15 years ago and the growth in U.S. production, basically to 13 million barrels a day is what it currently is, give or take 100,000 barrels here and there, has basically sucked all the oxygen out of the rest of the non-OPEC exploration and things like that. And so we've already, we know, if you know anything about oil and gas, I think a lot of the layman doesn't understand when they're driving through Texas or Oklahoma and they see a pump jack that this thing's going up and down and it just produces forever. That's not how it works. I mean, if you know the work of like Matt Simons or even Adam Rosenzweig talked about, a fellow that worked at shale in the 50s named King Hubert talked about declines in wells, oil fields, petroleum basins. They eventually do what? You start out the production curve, you grow, you eventually reach a plateau, and then you start in a decline. And the decline typically happens when 50% of the field is produced. And it doesn't matter how much longer you make a lateral. It doesn't matter how many more drilling rigs you throw at it. You're going to be in decline. And so the question one must ask about the oil market as far as supply is, one, what is our view on, what kind of a view do we have on the prospectiveness of U.S. shale? And when I say U.S. shale, you even have to distill it down further. My view on what's your view on the Permian Basin? And so I think that, because we've already seen like the Bakken, Harold Hamm's already said the Bakken's peaked. Okay. We know that the Eagle Ford's, I live here in Texas. I used to go to San Antonio, Austin all the time, Waco, go through the Eagle Ford. The traffic was unbelievable because that's all gone now. Okay. Doesn't mean that there's not any more oil there, but it's not the boom that it was. The Eagle Ford and the Bakken have basically peaked. Scoop in Oklahoma, these things they peak eventually. And so now we're relying on the Permian Basin to be the driver of supply. And then we have this view that incoming administration's talking about of drill baby drill or whatever, 3 million, the three arrows, 3 million barrels of more oil production, whatever I can't remember what the other ones are, but focusing on that. Well, that's not consistent with what the administration's saying, with what all the operators are saying. You can go look at Exxon, Chevron, some of the other operators. You've had a lot of consolidation now, like in the Permian. And so people are focused on what over the last several years? It's not drill, baby, drill, because the incentives have changed, Steve, for the managements. Okay. The incentives aren't grow production no matter what. That's what we did 5, 10 years ago. People were incentivized with stock options running the company, get the production up, but there was no cash flow. There was no earnings. Okay. Now that's changed. Shareholders want return of capital. They want dividends. They want share buybacks. They don't want drill, baby, drill. And not only that, the operators now, you have to listen to the conference calls. You got to listen to what's going on in the industry. This doesn't mean everybody. There's still independent operators there. If the oil price goes 10 up $10, they're going to go out and drill. I mean, it's just how it is. But are we near the peak? Okay. And what Adam Rosenzweig argues, and not just him, some others, is that we are plateauing now in the Permian. If that's the case, okay, if we are plateauing, and that it's not going to happen on this exact day it peaked, but you'll have a period where maybe a year or so it will plateau, start becoming obvious, and then it will actually go into decline. It doesn't matter how much money you throw at it or how many drilling rigs you throw at it, because it's a geological phenomenon.
It's not there. It doesn't matter how much money you throw at it.
Yeah, exactly. So then we turn to the view that, well, it doesn't really matter because OPEC has 4 million barrels of spare capacity. I don't know. I don't really believe what OPEC says. Maybe they do. But we know that when Saudi Arabia has had to crank up their production in the past, they're very either reticent or unable to keep it at a high level. So I wouldn't count on that. What I'm saying to you is demand's growing all the time, especially because of the emerging markets. And supply, I think, is going to be challenged going forward. And capital is going to become more expensive. Goes back to what we're just talking about with interest rates, things like that. And the people that are running these companies are not incentivized any longer just to drill for the sake of drilling. They actually have to get a rate of return. That's what they're judged on now. And so I think that can you have a severe economic displacement like a 2008 or a COVID thing where you turn off the world and oil drops to 20 or net goes negative or something crazy like that? Yeah, that'd be another buying opportunity of the century. But I don't think that's going to be the operating case. I think you're in a range, and I think that as it sets in the reality that maybe shale has peaked in the U.S. or at least plateaued, there's not going to be, I remember ridiculous newspaper articles in the McPaper. That's what I call USA Today. It's horrible newspaper, but I remember reading an article in there when I was at an airport one time when this thing first started. Oh yeah, we're going to get this thing up to 25 million. We're the new Saudi Arabia. Well, it has been very productive and a lot of wealth has been created, but it's not a cornucopia that lasts forever. And so one thing I like about the recent paper that Adam Rosenzweig wrote, the United States has already went through this before. And he talked about that. When conventional oil peaked in the early 70s, the Nixon administration attempted to stimulate production. They tried to incentivize, they did all these things, and they could not get production up. And this was in the context of the Arab oil embargoes. Oil was going through the roof. They threw everything they could at it. And guess what? It was a geological problem. We were over 50% of the oil in the United States had been produced. Therefore, we were in irreversible decline. Now, you could still, get your guys out there to do stripper wells and do workovers here and there, and you can arrest the decline. But remember what Exxon said in their paper a few years ago. The world is basically at 6 to 7% decline worldwide. So if you're at 104 million barrels a day and you're growing 1 million barrels a day, that's typical, okay? And you have 6 or 7% decline, that means basically 1% of demand growth plus 6 to 7 million barrels of decline. That's a new Saudi Arabia you have to find and bring online every year, and it hasn't been happening. And so shale has masked that, this cornucopia, this plethora of oil, this way. If that's coming to an end, and I think it is, I think it's going to plateau, then that's going to change the dynamic. But even at $70 to $80 a barrel, like I said, I have companies in my portfolio that have the managements are switched on. They've paid down their debt. I've got a company in there that got their debt down sufficient where they now are devoting. They have long life oil sands reserves in Canada, and they're paying 100% of free cash flow back to shareholders. And so that's a 10 to 15% annualized return. Okay, so when you're trying to be an active investor, and then you've got that, and then if you do get a move higher, You see what I'm saying? And then then you could have maybe an excess capital gain. So there are ways to make money here. I'm not opposed to it. Natural gas, I mostly watch what's going on in Europe because I think the same thing's going to happen in natural gas. It's going to probably peak also. Matter of fact, a recent report came out where year-over-year decline in production. So the counter argument is if the price goes high enough, they'll throw enough money and rigs at it, and that'll reverse it. Well, we'll see. That's kind of the disagreement right now in a nutshell. So, and I know there's been some discussions about some other things that are going on in the Permian around earthquakes and water disposal. I mean, I'm not enough of a geologist and I'm not out there. I don't know, but that's kind of the framework I'm working for overall with oil. But again, there's still opportunities. A lot of investment's going to have to go offshore now. And I think that that's an industry that's been constrained for a decade now, and it's not going to be able to absorb the necessary investment. And so I think I think those are some questions you have later, but that's kind of my framework for oil and gas right now.
Okay. So to summarize this, so basically oil demand is going up at the clip of about 1 million barrels per year. We've had an underinvestment in exploration in oil for quite a while. Capital is very likely going to get more expensive because of what we talked at the beginning of the interview. And shale looks like it's maybe not declining, but it looks like we're entering into a plateau here. And that's kind of masked since we've had so much of this extra shale oil coming online. It's kind of masked what will eventually be the problem when that runs out. So Trump's whole deal of drill, baby, drill, no matter how much money you throw at the Permian Basin, if the oil isn't there, you can't pull something out of the ground that doesn't exist.
Yeah, that's exactly right. And I think what you're going to see is I think it's already morphed from 3 million barrels to 3 million barrels of oil equivalent. And so if maybe you increase natural gas and you can convert that to barrels of oil equivalent. That's what they do a lot of times when in Canada, when they're talking about production of a company, it's, so many barrels of oil equivalent a day. And then you figure out, well, it's 40% natural gas, 30% oil and 10%, natural gas liquids. They all have a BTU content. Electricity has a BTU. You can convert all these things back and forth. And I think that's what you're going to see it morph into because it's going to be impossible to do that. It doesn't matter if you open up Anwar. It doesn't matter if you open up these places yet. People start looking at it, but I think you're going to walk into your boardroom and say, okay, well, we're halfway through this administration. I want to do $8 billion project up in Anwar. They're going to throw you out. They're going to be like, just keep doing what you're doing, man. Hold production steady, 1 or 2%, whatever, a little bit of production growth and return to cap. Everybody's happy. Wall Street's happy. The board's happy. You're just not in that environment where I think you're going to see people. I mean, Chevron said it themselves. People just need to listen to what the operators are saying. They said they're going to take it up to 1 million barrels a day and try to hold it there in the Permian. So they're not even trying to increase. And why would you do that? Because if you brought 3 million barrels of new shale, let's say you could do that, you're just going to crash the oil price. That's no economic incentive to do that. And so I think over time you're going to see this as if I'm correct in my analysis, this will set in, the market will start pricing these things in. And I think that's going to cause a shift to other things. I mean, Exxon, you see what they're doing, like an offshore Guyana. That's been a cornucopia for them. You have these places like that are growing, West Africa, offshore Namibia and the Orange Basin, Total, all these people down there. So there's a lot of potential upside in some places, but I think so goes the Permian, so goes the oil price. And then you have to start looking at, okay, what's the next, I mean, politics and being at the right place at the right time. YPF in Argentina is up over 100% this year. So it's a state-owned oil company. And because the Vaca Muerta shale is exploding with production. So you always have to, you just have to be switched on and be paying attention. So there's always opportunity. I mean, I'll throw a small junior out there if you want me to later on that I'm looking at. That's a penny dreadful that could go bankrupt or have some success. So there's always opportunity, but that's kind of my overall thesis of how I'm looking at the oil market.
Okay. Yeah. What's the penny dreadful?
I like this company just because a friend of mine introduced to me because he knows the people that are running it. it's a company called Tuck2 Resources, TUK, on the Venture Exchange. They are operating in the Southwest Alberta, in the Foothills Deep Basin, and they put this company together from a shell. They have some existing production, not much, few hundred barrels a day, but they just did a recent well down there, and it was very prolific. So I look for them to be delineating and doing some further drilling in 2025, something to keep an eye on. The first well they did was pretty successful. And so they're going to need to raise some capital. I mean, but it's a penny dreadful. I think it sells for 7 or 8 cents. But those are the kind of things that once in a while, if I come upon, I'll take a flyer on.
Yeah, yeah. What's the market cap? Like 10 million or something?
It's not that high. I don't remember off the top of my head. It's rinky dink. Yeah.
Okay, that is a penny dreadful. Thank you. Okay, so what you're saying goes right in line with the guest we just had on the show, Christine Guerrero. She did a 2-hour PowerPoint on the Permian Basin and the issues that they're going to have with the water out there. And I mean, she was talking about, one company's drilling over here and then they're putting the water back in where they're pulling the oil out and it's shooting up over in another, producer's oil coming, all these zombie wells. J-Bone has a question that goes kind of in line with that. He says, what are your thoughts on the water to oil ratio on the drilling being done in the Permian?
Well, like I said, I listened to the program, and I've followed Ms. Guerrero's work for a while. She's kind of polarizing. Some people don't like her, but I think, she has her views on things. She's a geologist. I'm not. I listened to it with interest. I think her data is there. I've seen some back and forth on Twitter or X with some other folks that were arguing with her, but you're still having the earthquakes too. But here in Texas, I don't know where you're at, but here in Texas, I mean, the Railroad Commission, all these people, they're not going to do it unless a town out there like collapsed from a 8 or 9. Nobody's going to do anything, So I don't really know enough about geology or what's really going on out there. I know people around here that do oil stuff, and with saltwater disposal, it's not a problem here with the wells. But there's such a volume of water there. I don't think I don't have enough. It's outside my circle of competence to speak to that.
Okay.
But I think people should watch that presentation. It's kind of long, but I think that she might be onto something. It piqued my interest.
Okay. All right. Yeah, we'll put a link up here if you guys want to check it out. Okay. Antonio is asking some company questions. Thoughts on Ovintiv and Baytex. Do you follow those?
No, I don't follow either one of those.
Okay.
Ovintiv is used to be the old Encana, I believe. So I think it's probably a decent company, but I don't know enough. And Baytex, I haven't followed it in so long. I don't even know what's going on there anymore.
Okay. And Joe is curious about Sitio Royalties. They're a royalty company out of the Permian Basin. Do you follow them?
No, I don't. But one thing I will say about royalty companies is I do like royalty companies. I think that they are very good businesses typically, but the problem with is that everybody knows that. So a lot of times they are priced accordingly. They're richly priced, let's put it that way. And so what I look to do sometimes is try to find a royalty company that's more up and coming, or I was like in a gold royalty company I bought where they had a project that was near a project that had failed, that had a land collapse in it. Like if you get a big price dislocation, you see what I'm saying? You should know what the asset values are in these companies, what you think their potential to cash flow. Then if you get a dislocation in the market, that's your opportunity to get in. Because if you're just buying them, so many people follow these things, and like I said, they're usually richly valued. So that's the only thing I would caution people. I don't know specifically about this one, but that's pretty typical.
Okay. How about Blackstone?
I do. My favorite, Blackstone's a good company. I used to own it. I just like TPL. I own TPL. I like it. I've owned it for a long time. It had a recent price dislocation. People should just buy TPL and be happy. Another company I like, it's not really a royalty company. I like what TPL's doing after they kind of changed things around, But I like this company Landbridge also out in the Permian that it recently came public. A lot of people think it's fly by night, but what they did is they bought a lot of mineral rights and surface rights, and what they do a lot of water processing. They have wells. They allow people to put disposal pipelines across their property. They get a lot of money from this. So does TPL, by the way. TPL cash flows about $100 million a year just on people transporting water across their properties. But anyways, Landbridge's basically deal is that, and I encourage people to go read Horizon Kinetics. Murray Stahl talks about this in he's probably one of the smartest people I've ever read. I've just become totally a big fan of Murray Stahl at Horizon Kinetics. I'm talking now about these AI data centers. You're talking about hyper centers and exocenters now, where you're talking about millions of square feet. You're not going to build this in Langley, Virginia, or on the East Coast. And the argument is in Landbridge already has a signed letter of intent that is to move these operations to West Texas, because you need three things for these things going forward. You need low-cost power. Well, you have a lot of gas out there gas production's increasing with the produced oil. There's not enough takeaway capacity, so you have relatively cheap gas prices, so you can build combined cycle behind-the-meter plants to run these things, combined cycle gas plants to provide power. You're out in the middle of nowhere, so it's easier to move data than it is to move the gas, okay? And what people don't understand about these new chips is they're not air cooled anymore. You used to be able to put a Bitcoin miner up in Iceland and just pulled outside air in. All this stuff's water cooled now, so you need tremendous amounts of water. Going back to what we were just talking about, they have a lot of water out in the Permian. You have a lot of land. You have a lot of gas. And so the idea is, if you're going to build a 1 million square foot data center, where would be it's like I said, it's easier to move the data coming out of it than it is to move the water, get the necessary water and energy, the pipeline infrastructure you need. So I encourage people to look at what Horizon Kinetics has been saying. Look at Landbridge. Landbridge is obviously a market darling that's moved quite a bit since it's IPO'd. But I think they're onto something, and I think even TPL is looking at this now also. And so I think, like I said, people say, well, they need to do a proof of concept. But like I said, they do have a LOI undisclosed with who it's with for a data center. So we'll see what happens. There's already people that are doing Bitcoin mining and stuff like that on a small scale with this gas generators and stuff. And even Alberta wants to get into this now. Same situation. So I think that's something I would take a look at that I find interesting. And like I said, TPL's probably, I wish I would have been introduced to that, 20 years ago. It's probably been one of the best performing companies of all time. And basically you have people just opening envelopes there and cashing royalty checks. But I think they got a little bit more switched on recently with their management changes they have. So I think they're going to utilize things a little bit differently. But anyways, yeah, those are a couple that I like. They're kind of like royalty plays, but not kind of pseudo royalty.
Yeah.
Like $100 million a year in free cash flow just for letting people transport salt water across your property. That's a lot of money, man.
Yeah.
So, so that doesn't even include all the oil and gas royalties that TPL gets. So I would take a look at that, because you're not going to build these things, like I said, in Langley, Virginia, or in suburban Atlanta. It's not going to be allowed. It's going to cost too much. And I think that's what you're going to see as a possibility. And like I said, it'll be proof of concept. The first time somebody builds one, then there'll be a floodgate of people. So we'll see.
Yeah. Okay. That's interesting. And that kind of goes in line with what Christine was saying too, is, as time goes on, they're going to produce more of this water, and companies like Landbridge are going to be the ones that will probably benefit from that. Okay, Eric, I think he is excited about Colombia because he's asking about Perix and Ecopetrol. Do you have any opinion on them?
Yeah, Ecopetrol, people should buy it. It could probably 5-bag over the next couple of years. I'll tell you why. It's a very well-run company. It's basically nationalized already. Colombian government owns most of it, but it trades a portion of it. They don't just do oil and gas. They do toll roads, electric pipelines in the country, power lines, all this stuff. You currently have a perception of Colombia, which I believe can be arbitraged. The current president there is a guy named Gustavo Petro, I think his name is. He's an avowed socialist. And when he got elected, the Colombian market, a lot of stocks sold off. They pretty much haven't done anything. So I don't know what the current dividend is at Ecopetrol now. I think it's like 20 or 30%, something crazy. I don't even remember.
Oh, wow. Okay.
It's a huge payer of dividends. But people need to understand, this is why I'm bullish on this. Kind of ties into the whole Latin America thing. You saw what's happened in Argentina with Malay. So in my last newsletter last month, I talked about what I think is a trend. You see the success that Bukele's had in El Salvador. You see the Javier Malay's success. People are watching this. They see it, okay? And people like Gustavo Petro are on their way out. I mean, people don't understand. These places are still democracies. They're multi-party. Yeah, he got elected, but he hasn't really been able to implement his agenda because the parliament, he doesn't have control of that. So it's kind of been stagnant. And so with oil prices down and this perception, incorrect, I believe, of Latin America, I think that, he's polling about 20% approval ratings right now. They're having elections in 2 years. As Stanley Druckenmiller says, we shouldn't look at a situation as it stands right now, but we need to look at it, where is it going to be in 12 to 18 months? So we're getting into that window. If you would go back and look at, I challenge people to do this. I just talked about YPF, which is a nationalized company in Argentina. It got nationalized. That's why there's a lawsuit against it. When the Kirchner government confiscated it, Repsol and all that stuff, there's a $13 billion judgment against them, okay? It has to be paid. But regardless, if you go back and look at the polls, and when Malay started running and climbing in the polls, you can look at the price as it became more and more clear that he had a shot of winning. Look at the price of what YPF did. This is in an environment where oil prices really haven't done anything in the last 2 years. And so you have a situation where things are perceived as being, for lack of a better term, crappy. Let's just say this is just a situation that could go from terrible to less bad, can result in several 100% change in valuation. Same thing in Colombia. Banco Colombia pays like an 11% dividend. CIB on the NYSE. EC is the symbol on the NYSE. So I think, then Petrobras and Ecopetrol just found basically the largest gas find in Colombia's history offshore. There's tremendous, tremendous opportunity offshore. It's basically unexplored Colombia. So yeah, I'm a big bull on EC, and I think that the political winds are changing in Latin America. I think that will create a perception change. And like I said, just that perception change going from, you're going to get a more center-right government in there eventually. Petro's on his way out, and that'll be it. But people will start sniffing that out. Can't wait till the day of the election. You got to kind of pay attention. And that means you got to go follow Colombian newspapers and download them and Google Translate and try to, that's work, right? So that's why there's this arbitrage opportunity. So I think, yeah, I'm a big bull on EC.
Okay.
I wouldn't go all in, but there's still a risk. But, I think it's a tremendous opportunity.
Okay. Yeah. Yeah. Kind of like we're trying to front run the Trudeau election in October 2025. I think we can all see that one coming, barring some. I think that'll be really profitable for us. Okay. Do you have any opinion on Parex?
Not really.
Okay.
I don't really follow it.
Okay. But you like Ecopetrol. Listeners are going to love that. All right. Matt wants to know, John, can you please tell us what you think about rig TransOcean?
Best offshore operator out there. Right now, this is a perfect example of offshore services, okay? We remember maybe a year ago as day rates started turning up and everybody was getting excited. We are in a new uptrend, okay? The cycle is up. Things have kind of stagnated recently with new contracts being signed, but I'm very bullish on basically all of these things. Valaris, TransOcean. You can, depending on who you talk to, they have their favorites. The problem with TransOcean is they're probably the one, if not the only company that didn't declare bankruptcy and deal with their debt. So they have a fairly large debt overhang. But I think the argument has been made, and I agree with it, that you're not going to, who's going to go out and build $1 billion, spend $1 billion two on building a 8th-generation drill ship? That's what it would cost you. And again, you're not going to go to your board if you're at Valaris or if you're at TransOcean and say, hey, I want to build it, because I could see in the future they're going to be like, you're nuts, man, get out of here, And so I think there's an overhang of some stacked equipment that's 6G and 7G. I don't want to get too far in the weeds, but again, if my thesis is correct, we're seeing, regardless, we're seeing increase in more FIDs, final investment decisions for offshore projects. Watch what's happening in offshore Namibia in the Orange Basin. Suriname's going to become another basin like Guyana possibly. And so it's the same story with all the offshore providers. Another place that it's done very well, just because the rig providers they kind of stagnated. These things are not linear, right? So they go in fits and starts. We're in kind of one of these lull periods. So I like the company. I own a small position, but once I see things start turning upwards again, I think that I think it could do decent. I think the days of it arguing whether it's going to go bankrupt or not are over. I think that they've been demonstrated themselves to be very savvy. And but again, it just depends what your view is. I mean, you can look at a Valaris. Somebody's looking; they're just buying back a lot of shares and stuff. I mean, certainly TransOcean's not in that spot to return capital to shareholders because they have this debt. But I think that whole sector has I've heard the argument made that there will never be another big drill ship built. You're not going to see this big build out because people still have the mentality of oil's going away, blah, 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 demand's going to peak, all these things. And so I think that, as the shift from onshore to offshore is going to happen over time, I think a lot of these companies will do well. It's just going to be a timing situation. You might have to sit there for a year or 18 months or 2 years. I don't know, that's the thing. So that's an opportunity cost people have to be aware of.
Okay.
But there's other sectors. I mean, the people that build look at a company like, I'm not going to give all my portfolio names away, but there's other companies that are doing very well, providing services that provide the pressure trees, that do underwater construction. There's so many companies that are doing well, and their stock prices have responded. So it just depends. Again, it's another one of those things where you have to kind of wade in there and look at what's going on. I mean, backlog. I have a company I like that trades on the London Exchange to provide these vessels, crew accommodation vessels that are self-moving. They're platforms that can move up to a drilling rig or to a production platform. They have workshops and berthing on there, and then the guys go back and forth and work. This thing's a turnaround story. It trades on the London Exchange. I think it's tremendously undervalued. It probably sells for a market cap of $150 million. They own 13 of these vessels. You couldn't build one of these vessels for less than probably $80 to $100 million. So they've probably got, $800 million to $1 billion worth of equipment selling for $150 million. Okay. And this thing's cash flowing, and the utilization rate in that sector is 92%. And they have a backlog that's 4 times the market cap. So there's things out there like this. You just got to turn over some rocks. That's all. I don't want to give the names away, but that stuff's out there.
Yeah, and if you're right in your thesis, and we start pulling more offshore than we are like out of the Permian, then companies like that will do really, really well. We are going to break this episode into 2 parts. When we come back, we will talk about the uranium markets, precious metals, and global politics. Make sure you subscribe and hit the little bell notification icon so you'll know when part 2 comes out. And thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.